Right now in Washington, something big is happening, and it's not just political noise. This is a moment that could quietly reshape America's financial future. As lawmakers return to Capitol Hill, a massive piece of legislation, often called the Big, Beautiful Bill, has taken center stage. Supporters say it's bold, transformative, and long overdue. Critics warn it could trigger a government shutdown with serious economic consequences. And here's the key question everyone on Wall Street is asking. What does this fight in Congress really mean for your money? Let's break it down. This bill isn't just another policy proposal buried in paperwork. It's a sweeping package that touches federal spending, long-term debt strategy, economic priorities, and political leverage all at once. At its core, the bill is designed to reset how Washington funds major programs heading into 2025 and beyond. Supporters argue it brings discipline, reduces waste, and restores confidence in the federal system. They frame it as a financial course correction, a way to stabilize the economy after years of uncertainty. But opponents see a different picture. They argue the bill moves too fast, cuts too deep, and uses the threat of a shutdown as a bargaining chip. And that's where the showdown begins. Because without agreement, parts of the federal government could grind to a halt. Historically, shutdowns aren't just political drama, they ripple through the economy. Federal workers face delayed paychecks. Government services slow down. Consumer confidence weakens. And markets? They start pricing in risk. In early trading sessions, investors are already watching every headline closely. Treasury yields fluctuate with each news statement from congressional leaders. The dollar reacts to uncertainty, and volatility quietly creeps back into financial markets. What makes this moment different is timing. This debate is unfolding as the U.S. economy enters a delicate phase. Inflation pressures haven't fully disappeared. Interest rates remain elevated, and households are still adjusting to higher costs of living. That means any disruption, even temporary, could have outsized psychological impact. Inside Congress, negotiations have become tense. One side insists the bill is necessary to protect America's long-term financial credibility. The other side argues that forcing such a massive change under shutdown pressure sets a dangerous precedent. Neither wants to blink first. Behind closed doors, lawmakers are weighing more than politics. They're calculating market reaction, voter sentiment, and international perception. Because the world is watching how the United States handles its fiscal responsibilities. Credit agencies are watching too. Any hint of prolonged dysfunction raises uncomfortable questions about debt sustainability and governance. While no immediate downgrade is expected, analysts note that repeated brinkmanship slowly erodes trust. And trust in finance is everything. For everyday Americans, the effects may not feel immediate, but they're real. Retirement accounts react to volatility. Borrowing costs respond to uncertainty. And businesses delay decisions when Washington appears unstable. That's why this big, beautiful bill fight matters far beyond Capitol Hill. It's not just about who wins politically. It's about whether the system proves resilient or fragile at a critical moment. As the deadline approaches, pressure is building. Statements grow sharper. Media coverage intensifies. And markets brace for clarity, one way or another. Because in finance, uncertainty is often more dangerous than bad news. And right now, uncertainty is exactly what Congress is producing. This is only the first chapter.
As this showdown stretches on, a deeper question emerges, one that goes beyond a single bill or a single deadline. Is this the new normal for America's financial governance? Over the past decade, markets have learned to live with political tension, but each standoff leaves a mark. Investors don't panic immediately. Instead, they adjust expectations. They hedge. They pull back. They wait. And waiting slows momentum. The big, beautiful bill has become a symbol of that tension, not because of its name, but because of what it represents. A struggle between long-term reform and short-term stability. Supporters argue that bold action is impossible without confrontation. They believe meaningful financial change requires discomfort. From their perspective, temporary disruption is a price worth paying for future stability. Critics counter that stability is the foundation of growth, and that playing chicken with a shutdown undermines confidence at the worst possible time. Markets tend to side with predictability. That's why even rumors of a shutdown can move prices. Algorithms react in milliseconds. Institutional investors rebalance quietly. Volatility doesn't always explode. Sometimes it just simmers. And that slow burn can be just as damaging. International partners are paying attention as well. The US dollar remains the world's reserve currency, but its strength depends on faith in American institutions. Repeated fiscal standoffs invite uncomfortable comparisons and questions. Meanwhile, businesses across the country are watching closely. Government contracts, regulatory approvals, and funding pipelines all depend on a functioning system. A shutdown, even a partial one, introduces friction into an already complex environment. For households, the issue feels distant until it isn't. Consumer sentiment is sensitive. When headlines turn negative, spending habits shift. People delay purchases. Confidence weakens. And that behavioral change feeds back into the economy. This is why financial news isn't just about numbers. It's about psychology. And psychologically, this moment matters. As 2025 approaches, the stakes rise. Lawmakers know this isn't just another budget fight. It's a test of credibility, leadership, and economic maturity. Will compromise emerge at the last moment, as it often does? Or will this time be different? Markets hate surprises. But history shows Washington sometimes delivers them anyway. The coming days will reveal more than a vote outcome. They'll reveal how prepared the system is to handle pressure and how much risk investors are willing to tolerate. Because in the end, the real cost of a shutdown isn't measured in headlines. It's measured in confidence. And once confidence is shaken, rebuilding it takes far longer than passing a bill.